Hey there, GoPro kids. Starting my second lesson on personal finance today. If you haven't watched the first one, I recommend you watch the first video before you watch this one. The first video is talking about things like behaviors and how behaviors are really important to being good with finance. And then I got into another, what I think is the most important concept you need to understand is this idea called compound interest. That is, investing early and investing often will be your best friend in your path to any kind of wealth. Honestly, it's investing early and investing often. And we also talked about owning your own business being the most successful way if you want to achieve this idea called financial independence. So today I'm going to dive into an investing. So full disclosure, yes, I work, my company is a registered investment advisory. And so I can't recommend specific investments for you because legally, for anybody, I have to gather a bunch of information from them. I have to know what their current financial situation is, what their goals are, what their risk tolerance is, just to mention a few, before I can recommend any kind of investments. So what I'm going to do is give you a general philosophy of investing. I will also show you what my son Tristan is invested in his Roth IRA. And then you can decide if that's something that you want to pursue at that point. Okay. So again, if you have any questions on this, feel free to email me, and you're not bothering me at all. I have nothing else to do right now besides just play golf. And so I hope this kind of piques your interest into the realm of personal finance. This unit is supposed to be just a very surface level unit. And then you need to go find more information if you want. I'm going to give you some resources today, maybe a book to read, some websites to look at, a podcast or two to listen to if you're interested in this kind of thing. Okay. All right. So here we go. Let me share my screen with you here again. And here we go. Okay. So let's talk about different accounts that you can use to invest. A lot of times when I hear people and I talk to them the first time, they say, yeah, I invest in my Roth IRA, or I invest in my 401k. Those are my investments. And that's really not correct. Okay. So you have to look at 401ks, 403bs, 457s, IRAs, Roth IRAs, taxable brokerage accounts. Those are like shopping carts at the store. If you were to go to Costco and somebody asked you, what'd you buy? And you said, I bought a shopping cart. They would look at you and say, what do you mean you bought a shopping cart? A 401k or a Roth IRA or a taxable brokerage account, those are shopping carts. Those aren't the investments. Those are what hold the investments you want to choose. Just like when you go to Costco or Save Mart or Walmart, you push a shopping cart around and then you place the products that you want to buy from the grocery store in the cart, right? Same thing, a 401k, a 403b, a Roth IRA, a taxable brokerage account, that's the shopping cart. And then you pick what investment products you want to hold inside that account. Okay. So let's go over just a few basic differences between a 401k, a IRA, Roth IRA, 403b. All of these 401k, 403b, 457, you get these through your employer. A 401k is usually through a private company. And then your 403b or 457s are usually when you work for either like a nonprofit or for like a government, like a state or a municipality, right? So for example, teachers have 403bs. Some city people that work for the city have 457s, right? 401ks are usually through a private employer, or maybe sometimes a private nonprofit, but most of the time they have a 403b, okay? A 401k, 403b, 457, the money is deducted directly from your paycheck. So before you ever see the money, it comes out of your paycheck and goes into your 401k, 403b, 457. Now you get to choose how much gets taken out of your paycheck. So you can make that go up, you can make it go down. And then you don't pay taxes on this. This is what's called tax-deferred. Now these are retirement accounts, ladies and gentlemen. These are all for when you retire. This is not for I'm saving money to go buy a car next year, or I'm going on vacation in 6 months. These are money that you're putting away to save for when you can't work anymore. Okay. Now, all these right here, 401k, 403b, 457, you elect to take money out of your paycheck. And then based off whatever you elect, they put that money into your 401k account or your shopping cart, your 403b account or your shopping cart. Okay. And then it actually reduces how many taxes you pay. So let's say you put $10,000 into your 401k this year, but let's say you made 70,000. You would actually get to tell the federal government and the state government that you only made 60,000. So you get to sort of hide that $10,000 from the federal and state government, and it's tax deferred. Now, when you withdraw the money out in retirement, and you really, for the most part, you can't access that money until you're 59 and a half. Most people don't access it until when they actually retire. When you take the money out, then you're going to pay taxes on it. Okay. So it's tax deferred, not tax free. So I highly recommend, especially if your employer gives you a match, many 401k plans, they will match money that you put into your 401k up to a certain amount. So for example, let's say that you put in 3% of your paycheck, a lot of companies will match that 3%. So if you're making $60,000 a year and you put away 3%, and I know you guys don't do math very quickly, but if you were doing 3% of $60,000 a year, that would be how much? That would be $1,800, right? A lot of times your employer would say, okay, we'll match that $1,800. And so it's really like you're putting in 6%. Every company has different match plans that they do. Some companies match up to 5%, some companies match up to 7%, some don't match up at all. So it just depends. But if you have a 401k or a 403b or 457, and there is a company match, that should be the first money that you use for retirement, because that's like free money. Okay, you don't want to leave that money on the table. So if you get a company that has a 401k and they match your 401k, that should be your first priority, is to put that amount into a 401k. So if they match up to 2%, make sure you're putting away 2%. If they go 3, put 3. If they put 5, put 5. Okay, that's your first priority, is to put that money into that. Okay, and remember that money, it's tax deferred, so you won't pay any taxes on it in this year, but you will pay taxes on it once you withdraw it from these out of here. Okay. Now, an IRA is like your own individual 401k. What's going to happen is that many of you are going to have 4, 5, 6, 7, 8, 9 jobs when you work through your career. What you want to do is, for the most part, not always, but for the most part, when you leave that company, you want to take that company's 401k and put it into a IRA, which is called an individual retirement account. So why that is beneficial is that you keep all your money in one place. You don't want to have 8 or 9 401ks just floating around out there with a little bit of money in each one, and you really don't know what each one's doing. Okay. For the most part, now not always, there are exceptions to the rule on this, but for the most part, as you leave a company and you have a 401k, then you go to another company and you get another 401k, you want to roll this 401k into an individual retirement account. There's no tax consequences because they're both considered the same by the IRS as far as taxes are concerned. And that way you have all your money in one place and you can see what your retirement accounts are, and you know what all of your money is doing. You don't have like 6 or 7 different 401ks and all of your money is doing different things and you're not sure what to do. Okay. Now, what I recommend for you at your young age is to set up a Roth IRA. Okay. If you don't have a company that has a 401k, you want to set up a Roth IRA. Okay, this is what Tristan has. He's 18, he's working, he's putting money into a Roth IRA at the age of 18. Now, you set up the Roth IRA, the money comes out of your bank account, not your paycheck. So you actually link up your bank account with the Roth IRA, and then the money gets withdrawn from your bank account. Okay, here's the cool thing about a Roth IRA. A regular IRA and a 401k, that money's tax deferred. In a regular IRA, what's called a traditional IRA, and in a 401k, that money's tax deferred. You're going to pay taxes when you take money out of your IRA or your 401k. Your Roth IRA grows tax-free. So you could put $6,000 a year into a Roth IRA. That's the most you can do right now at your age. Okay, if you're older, there's a catch-up provision. So because you aren't taking that money out of your paycheck, you've already paid taxes on the money you're putting into a Roth IRA. So you get paid, the money goes into your bank account, and then from your bank account, you fund your Roth IRA. However big your Roth account grows, that money is tax-free when you withdraw it. Okay? So however large your Roth account goes, you can withdraw all that money and not pay any taxes on the gains that you have. Okay, that's a really cool thing. At your age, I would definitely recommend doing a Roth IRA. Now, you can do both. I do both. Okay. If your employer has a match on their 401k, my recommendation is if they have a 3% match, and let's say that turns out to be $2,000, put your $2,000 into your 401k and get the other $2,000 from your employer on the match. That means you have 4,000. And then if you still have another 6 to invest, or even less, you don't have to do 6,000, fully fund your Roth IRA. That way it's like you've actually invested $10,000 for the year. You put in 2 into your 401k, you put in 6 into your Roth IRA, and then your employer put an additional 2,000 into your 401k to match, and it's like you invested $10,000. But now you have some tax-free money in a Roth IRA and some taxable money in a 401k. Now, again, just like a 401k, you can't get that money out penalty-free until it's 59.5. Well, let me say this. Your contributions to a Roth IRA, you can deduct at any time, but that's not how you should treat it. Once you put the money there, you should leave it there until your retirement. Your gains you make in the Roth IRA, you can't withdraw them until you're 59.5 without paying a penalty. Okay? Now, I believe you can do up to $18,500 a year in a 401k, $6,000 a year right now for your age in a Roth IRA. So that's $24,500. That's probably going to be more than any of you can invest in a single year. But if you have more and you want to invest, then you would go want to invest in a taxable brokerage account. Okay. Now that money comes out of your bank account. You don't get any tax deferral, and you're going to pay taxes on the money when you take it out on the gains on how much money you've made. So if you put in $10,000 into a taxable account and then you made $5,000 and you withdraw all $15,000 at once, you're going to pay taxes on the $5,000 because those are what your gains were. Okay. So these are the basic 3 shopping carts that you can have: 401ks, IRA, Roth IRA, and then taxable accounts. I recommend that if you have a 401k option, try to get it, get the company match. Okay. If you don't have it, or even if you do, try to set up a Roth IRA. Okay. Now, again, these are just shopping carts. What do we put into the Roth IRA? All right. Well, that is where we talk about what are called asset classes. You can buy stocks in your IRAs, 401ks, taxable accounts. You can buy bonds. You can buy real estate. You can have commodities like gold and silver or crops, or you can just put cash in there. Okay. But these are all what are called asset classes. These are the things that you can buy, or products you can buy to put in your Roth IRA, 401k, taxable brokerage account. Okay. So these are the very different asset classes. Now, again, as an investment advisor, what I do is I walk people through a process. I figure out what their investing goals are, what's their time horizon, what's their risk tolerance, how much money do they have, how much money do they need. There's a lot of different variables I take into account before I start putting these together. If you go to see anybody about investments, and the first thing that they talk about is the product that you should use, you need to run away as fast as you can, because that person's not an investment advisor. They're a salesman posing as an investment advisor. A true investment advisor, like myself, is a fiduciary. That is, they put your interests first. They don't sell you products like a car salesman. Okay. A true investment advisor that is a very good fiduciary will sit down and ask you questions. They'll figure out your situation, and then they'll put you in the investment that is best for you in your situation, not what makes them the most money. Okay. People have a hard time finding out what a good financial advisor is. And quite frankly, at your age, I don't think you need one, ladies and gentlemen. Okay. At the age of 18, 19, 20, 22, I don't think you need a financial advisor. You just don't. I'm going to show you what I think some good places to invest in, and you can just bypass investment advisors. Now, as your life becomes more complex and you have, say, multiple jobs, maybe your own business, maybe you're married and both of you have 401ks and Roth IRAs, and maybe a SEP IRA because you're self-employed, or a solo 401k, and you also have real estate, whatever. Now an investment advisor could be appropriate for you, okay? Because investment advisors are used to dealing with complex financial situations. At your age, you don't need an investment advisor. You just don't, okay? And what I'm going to do is show you how I think you should invest in these mix of asset classes, okay? Now, I don't think you should buy, I think you should be in the stock market, but at your age, I don't think you should buy individual stocks. Even at my age, most people I don't think understand how to invest in individual stocks the right way. So I believe you should invest in what are called mutual funds. Okay. Mutual funds are a product, an investment product that buys a lot of stocks at one time, or they buy a lot of bonds at one time, or they buy a lot of real estate at one time. So in essence, the mutual fund picks the stocks, they pick the bonds, they pick the commodities, they pick the real estate for you. And so you are basically paying to be in a mutual fund that does the work for you. And one thing about investing is that we know is that the simpler it is for beginners, the more likely they're going to stay with it. And so everything I want you to do, I want you to have it be automated where you're not thinking about it. Okay. So I want, if you have a 401k, I want you to set it up to where it's automatic and you don't think about it, and it automatically goes into your 401k, and it automatically picks, and it automatically goes into the mutual fund you've already selected. Right. So you're not having to do it every single time you get a paycheck, because if you do, you're going to mess it up. You're going to forget about it, and you'll get tired of doing it. So automate it. Okay. For your Roth IRA, I want you to set up to where it automatically comes out of your bank account, and then it automatically goes into the mutual fund that you've selected. And so on a weekly, monthly, annual basis, maybe every quarterly, whatever you want to do, set up your Roth IRAs, your 401ks, where it's automatic and you don't have to think about it at all. Just where the money comes out of your paycheck, the money comes out of your bank account automatically and goes into the mutual funds that you've already selected. Okay. The more you can automate your finances, the better off you're going to be, because out of sight, out of mind is how you become a successful financial person. Just where you're not thinking about it all the time. There's a whole industry out there called behavioral finance that shows that. Okay. Now, there's several different kinds of mutual funds out there. Index funds are what I suggest you use. There's also what's called actively managed mutual funds. Now, I'm not going to get into the weeds. If you want to pause it and you want to read this and you want to go investigate the difference between index fund and actively managed funds, I suggest you use index-based funds. Okay, especially at your age, they're easy, they're simple, they're very low cost, and I want to show you why that's so important. Okay, many of you have heard of Warren Buffett. Okay, Warren Buffett, the Miracle of Omaha, is probably the most famous investor of our time. Warren Buffett put together a bet with the 5 best actively managed mutual fund advisors. Okay, an actively managed mutual fund is a mutual fund where you have a team of people that pick what stocks to buy, what bonds to buy, what real estate to buy, and they pick and pick and pick. An index fund doesn't do that. It's a very simple process. I don't want to bore you with the details of how an index fund works, but Warren Buffett went to these 5 top actively managed mutual fund advisors, and he said, I will bet you that I can beat you with an S&P 500 index fund versus your stock picking over a 10-year period. And whoever wins has to donate, I think it was $1 million, to the charity of the winner's choice. Okay. So this was the result of the fund. After 7 years, the New York Times kept publishing it. So each of them invested $50,000 for 10 years. And these were supposedly the top 5 mutual fund, actively managed mutual fund advisors out there, or actively managed mutual fund managers out there, versus Warren Buffett. So Warren Buffett put $50,000 just in the S&P 500 index fund, which is a very simple fund. It's the 500 largest companies in the United States for the most part. And then these other investors were buying and selling, picking stocks, buying stocks, selling stocks, all those things. After 7 years, they actually shut it down because the New York Times kept showing the study, and Warren Buffett was just beating the pants off of them by just buying a simple index fund. And they shut it down because it was kind of bad publicity for them, because their investors started withdrawing money of like, why am I paying all these fees to invest with you? One of the reasons I really like index funds is because they have such low fees. Index funds have extremely, extremely low fees. It's almost like investing for free. Actively managed funds have very, very high fees. And they typically, you're going to do fine if you pick an actively managed mutual fund. I'm not saying never be in an actively managed mutual fund, but for a simple investor such as yourself, this is the way to go. Okay. This is the way to go. Where should you buy your index funds from? Where, if you're going to open up a Roth IRA, now your employer's 401k is going to be dictated to you by your employer. You won't have a choice of where to go. For your Roth IRA though, you choose where to go with your Roth IRA. I would say go to one of these 3 places: Vanguard, Schwab, Fidelity. Vanguard, Schwab, and Fidelity, again, when I ask people what you're invested in, they say, I'm invested in Vanguard. I'm invested in Schwab, I'm invested in Fidelity. Vanguard, Schwab, and Fidelity are like grocery stores. Okay. If you tell people I went to the grocery store and then they ask, well, what'd you buy? You said, well, I bought Costco, or I bought Walmart, or I bought Save Mart. They would look at you funny and say, what do you mean you bought Costco? Vanguard, Schwab, and Fidelity are like grocery stores that all sell groceries. Okay. So don't say you're invested in Vanguard, you're invested in Fidelity. Vanguard is a place that holds your investments for you. Schwab is a place that holds your investments for you, right? Your Roth IRA would be the shopping cart you use to buy products while you're at Vanguard. Your Roth IRA would be the shopping cart you use to buy investment products while you're at Schwab. Okay, so that's the best analogy. Don't go to banks, don't go to credit unions, don't go to an insurance company. Any insurance company, you don't want to do investments through them. Okay, you just don't. Insurance companies are great. They have a great use, and there's many useful products that insurance companies sell, but their investments, in my opinion, I'm licensed to sell them, and I just don't sell them because they're bad for my clients. They're just bad products. Don't go to a commission-based investment advisor. That's somebody who makes money every time you make a transaction. Okay. You want to cut all these people out and just go directly to the store to buy the product. Okay, go directly to Vanguard, go directly to Schwab, go directly to Fidelity, okay? Now, what I'm gonna do is I'm gonna bring up these websites and I'm gonna show you some possibilities of what I think would be good investments for you. I'm not gonna say that this is what you should buy because I don't know your situation, okay? But I'm gonna tell you like what Tristan's in and why Tristan chose that investment. And then if you think that's appropriate for you, then you go ahead, okay? But my recommendation is if you're gonna do a Roth IRA, go to one of these three right here. They're all very reputable companies. They have good investment products. They have good index funds that are very, very low cost. Okay, that would be my recommendation to you. Okay, so let me stop sharing this one right here. And let me come to where's my webpage? Right here. Okay, so here is Schwab's. Here's Schwab's page, Charles Schwab. Here's Vanguard's page, and here is Fidelity's page. Also, you know, if you wanted to go to say E-Trade, E-Trade would have some pretty good investment products too. Wealthfront or Betterment, those are the robo-advisors. You would probably be okay going to them as well. I like these because you're coming straight. So Wealthfront and Betterment actually buy investment products from Vanguard and from Fidelity and from Schwab, and then they charge a fee for that, right? So we're trying to cut out the fees. Let me explain to you why it is I'm so big on low fees. Take a look at this up here. Let's say that you're going to make 7% on your return. I think over time, I think 7% is a reasonable return to get over time if you're heavily invested in stocks, okay? And let's say you're paying your current total fees of 2% a year. You're going to have to pay fees to invest. So many times the mutual fund charges a fee, or the mutual fund manager charges a fee, or maybe you're with an investment advisor which charges a fee. So all those fees. A lot of investment advisors will charge 1%, and then they'll put you in mutual funds, which will charge another 1%. And so you're paying 2%. Okay. Well, you can go to, say, Charles Schwab, and you can get a mutual fund which you pay 0.08%. Okay, it's almost like investing for free. So let's say you start off at 22 doing this, or 18. I mean, most of you aren't going to do this, but let's say you start off with $10,000, which is a lot, but you know, start off with that. And then let's say you decide you're going to, at 22, invest fully in that $6,000 Roth IRA, which is what you can do every year, right? Now, look at how much these fees are going to impact you. Remember the lesson I talked yesterday about compound interest. Compound interest is where you make interest upon interest. Well, just by cutting your fees from this to this, you're going to make 1.9% more. You're going to make 1.92% every single year. Well, that 1.92% every year over, say, 43 years, watch what happens to the compounding effect of that 1.9%. Look at the difference now. This is going to say if you went with the 2% fee versus the 0.08%, or what's called 8 basis points. Look at the difference. So over that 43 years, you saving yourself that 1.92% is going to make you almost $700,000 more. Okay, why? Because that 1.92% has compounded. First of all, you've made 1.92% for 43 straight years. And if I just do the math on that real quick, I mean, even if we didn't do compounding on that, I mean, that would give you 82% more right there. But then you throw the compounding onto that and it becomes huge. Okay. So fees matter. Now, that's not the ultimate thing. I've never heard of anybody who didn't retire because they paid high fees. Even if your 401k has high fees and your employer has a match, I don't care. Go get the match from your employer because that's free money. Okay. Now, try to pick the lowest fee option inside your 401k, right? But, even if it has high fees, and even if your 401k has high fees and that's the only place you can save, then you want to keep saving, right? High fees are not going to stop you from having financial success. Your savings rate is what's going to impact your financial success. So if you have a good savings rate and you already have good investments and you already know that, hey, I have a good savings rate and have a plan, now try to find the lowest cost fee for what you're going to do. And that's why I like index funds. Okay. I mean, this is just, it's insane to figure how much these fees can cost you, right? I mean, even if you go from 1% to 0.8%, look how much that can make. That's still $383,000 over 43 years, right? So pick low fee options, because if you go with investments, which are really expensive, these expensive investments have to beat your investment by 2% every year just to even break even and make it worth it, right? And just the odds of them beating the index funds. Now, if you want to go research index funds, go ahead, but most people don't beat index funds over the years. Okay, even professionals don't beat index funds. Okay, over a long period of time. I'm talking like 10, 15 years. Now, let me give you an example. If you're going to do Roth IRA at Schwab, this is what's called a target date fund. All right. So right now is the year 2020. This assumes that if you buy this fund, that you're going to retire in 40 years. So if you're 22 right now, they would say you would retire at 62. Okay. Now, let me just explain what a target date index fund is. First of all, look at the expense of it. It's 8 basis points. That's almost like investing for free. If you invest $6,000 a year into this one right here, this is what Tristan has. This is what he selected. You're basically going to pay $5 a year in investment fees. It's almost like free. But let me show you what makes up this investment. So I'm going to click on portfolio here. And so we look, and they have basically chosen a bunch of investments for you. All right. So instead of you having to go pick, do I buy US stocks, international stocks, real estate, bonds, commodities? Do I do cash? Which international stocks do I buy? Which US stocks do I buy? They have done that for you. Okay. And so you can see here that they have selected that 50% of your stocks are going to be in large US companies, right? These would be like Google, Apple, Facebook, Amazon, Chevron, Walmart, you name it, right? That's going to be in here. And then they're also going to give you some small companies in the United States of which you've never heard of before, right? But small companies tend to grow more. They're going to give you some international companies, many of which you've heard of before, okay? Honda, Toyota, right? Big, large companies that, DuPont, these are companies that are from, Airbus that makes airplanes, right? And then here they're going to put you in what are called emerging markets as well. This is like Brazil, Russia, India, China, places like that. And then REITs, these are real estate investment trust. That's what a REIT is. So they're going to put you into real estate, so you don't have to do it on your own. This basically does it for you, ladies and gentlemen. This is going to put you in thousands and thousands and thousands of investments across the world. And all you have to do is put all of your money into one of these. Now, this is a very aggressive one. Okay, if you want something that's less risky and something that you won't lose as much money on possibly, because this is an aggressive one, you could go to a 2040 fund, right? But that would be more conservative for somebody that's only 20 years out for retirement. Now, I'm not guaranteeing you're going to make money in this, but we've never had a 10-year period in the stock market that did not have gains in the last 100 years, okay? Every 10-year period in the stock market has made gains in the last 100 years, okay? So this is something where if you want to do this, you can't be checking it all the time. Have the money come out of your bank account into your Roth IRA, put it directly into one of these target date funds here. And there's a bunch of other target date funds that you could pick from. You could call up Schwab and they'll actually walk you through the process of picking the correct target date fund for you. I'm just showing you this one because this is the one that Tristan has right now. Okay. If you were to go to Vanguard, the equivalent of this at Vanguard would be Vanguard's 2065 target date fund. Then again, look at the extremely low fees, 15 basis points. And then you look at the portfolio that it has. So you can say that the portfolio here, they have 55% in the US stock market, 36% in the international stock market, and then they have about 9%, 10% in bond markets around the world. Okay. If you look at Fidelity's here, Fidelity is, they have what's called their Freedom Fund. So Fidelity's is called the Freedom Fund. Vanguard's is called the Target Retirement Fund. And same thing, Schwab's is called their Target 2060 Fund. They're kind of all the same thing. But again, you take a look at Fidelity's, the expense ratio, very, very low here, low cost right here. And then you can look at the composition of it. And it shows here that they have 54% in the US stock market, 35% in the international stock market, right? And then they have about 8% in bonds, and then they have about 4% in cash or short-term bonds. Okay. So, those would be three places you could go. And again, call them up, call up Schwab, call up Vanguard, call up Fidelity, whichever one you're most comfortable with. I have clients with accounts at all three that custody for me. All three are very reputable companies. Call them up and say, I'm interested in starting up a Roth IRA, and I need some help selecting an appropriate investment for me. Okay. So there's that. And what was I going to say? Okay. So that's some areas that you can invest in. Again, I'm not recommending that you do these as investments. I'm just saying this is what Tristan chose. And for a person of your age, these might be appropriate for you, but they might not be appropriate for you because I don't know your individual situation. Okay. But just remember that this is not money that you're saving for when you're going to college. This is not money you're saving to buy a car next year to go on vacation. This is not money you're saving when you want to save up to buy a house. This is money you're saving for retirement when you're over the age of 59 and a half, 60 or later. Okay. But remember, we looked at that compounding. The earlier you start, the more you're going to have saved and the more options you're going to have when you reach that retirement age. Okay. So that's the investing part of it. Let me stop share here. Some books I think you might want to read about investing, or some websites you might want to go to. Let me go and share the screen here. Let me see if I can bring this up again. Yeah. Let me close some of these out here. So this is Boggleheads. Boggleheads is a pretty good website. If you really want to dive into investing, this is going to be way more information than most of you are ever going to need ever. But so you can go on to their forum, and there's tons and tons and tons of information about investing that you can find here. Okay. More so than I could ever teach you. And this gets really into the thick of the weeds. Every single investment strategy in the world is on here, but go ahead and take a look if that floats your boat. Okay. Another one I would recommend is there's a retired investment advisor out there, and maybe it's there it is. He has a whole website. Paul Merriman is a retired investment advisor from, I believe, from Seattle, Washington. And he's got a whole set of books that he has. He has a podcast that he does, and he has a whole investing philosophy that's it's okay. I mean, there's a lot of different ways you can invest. Okay. I'm just showing you one way here. He's pretty good. He doesn't have a conflict of interest, and he's pretty thorough, but he's heavy into numbers. He has a lot of spreadsheets, and if you're not a numbers person, then okay. a website I think you might like, which is has some pretty good information, is a site called Doe Roller. He actually has what I think is one of the best podcasts out there on just personal finance. Now, a lot of his podcasts are on investing, but a lot of them are also just on other things like credit cards, taxes, insurance, investing, going to banks, all these different things. He's got a very good podcast that if you like to binge listen to podcasts while you're exercising or driving or whatever, the Doe Roller podcast is a pretty good podcast. Okay. So I hope I've piqued your interest a little bit in investing, ladies and gentlemen. And remember, investing, you don't have to be a financial genius to be a successful investor. What you have to do is invest early, invest often, and stay the course. Don't panic when markets go up. Don't panic when markets go down, and don't celebrate woohoo when markets go up. You just keep putting money in every single month, every single year, and just keep going, keep going, keep going. And the problem that most people have is they start, they stop, they put money in, they take money out, they keep changing their investments around, and you are going to be your own worst enemy when it comes to investing. Okay. Pick one of those target date funds from one of those places that you think is appropriate. Call somebody from Schwab, Vanguard, or Fidelity. They'll walk through the process. Pick one of those that's appropriate for your situation, and then stick with it and just keep going and going and going and going. Don't check your balances every day. Don't check your balances every week or every month. Don't buy and sell and buy and sell and buy and sell. Just keep putting money into one of those target date funds, and they'll take care of it for you. Now, that's not the best way to invest. Okay. I'm not going to sit here and tell you that target date funds are the end all be all. Okay. But for somebody that doesn't like this stuff, for somebody that's a novice investor, for somebody that isn't interested in numbers and different investing theories, that's going to be just fine for you. Now, if you are really interested in that, those 2 websites or those 3 websites I gave you are enough to get you started, to where if you want to start diving in and figuring out more in investing, that's just scratching the surface. You'll have way more to go than what you need. But I wouldn't get too thick in the weeds of that. If you find an investing philosophy that you like and then you do it, the key is to stick with that investing philosophy. Where people get into trouble is they switch from one philosophy to another philosophy to another philosophy, and they never let the philosophy have time to work. Okay. If that's you and you're going to start buying, selling, changing philosophies, doing all this stuff based off whatever it is, you're not going to be a good investor. Okay. The key is that don't think that anybody has some magical knowledge about what's going to happen in the stock market. Anybody who tells you they know that this is going to happen in the stock market, they're either trying to sell you a product, sell you some sort of book, sell you on their website, or they're trying to pump up their own selves so they can make more money promoting themselves. Okay. Whenever I hear somebody that says, I predicted correctly what happened in the stock market on X year, then I go back and look and I see that they usually made a bunch of other predictions they were wrong about. Well, it's easy to make a correct prediction when you make 50 predictions and 49 are wrong and you just tout the one that you got right. Okay. Nobody knows where the market's going to be in 1 year from now. Okay. Now, do we have a good idea that in 5 or 10 years, the market's going to be up? Yes. Yeah, we do. We don't know how much it's going to be up. 20 years from now, we would almost guarantee that the market's going to be up substantially. Okay. What you don't want to do is buy at the wrong time, sell at the wrong time, miss out on market gains. When the market crashes, sell at the bottom because you're afraid of the market. Keep putting money in every single month, every single year, and you will be amazed at how much your balance on your retirement accounts grow. Okay, now this is just for investing. I'm not talking about savings accounts. I'm not talking about buying a house or buying a car. We're going to cover that later. This is just for investing. So I'm going to stop that there. All right. I hope I gave you some things to consider when starting investing. If you have any questions, again, feel free to email me and I will try to respond to those in the best way I can. Remember, I do work for a registered investment advisory. That's my company, CWS Asset Management. And so I'm sort of limited into what I can and cannot tell you to do. I have to be very general because I don't know your individual situation, but I hope you're finding this useful and interesting, and I hope everybody's doing okay. So everybody take care, and I'll be posting some more videos in the next few days.